Let's get right into it. Today's Tokyo capital markets saw a massive structural defense of critical thresholds right in the middle of consolidating sovereign yields. Welcome to your Institutional Explainer for August 26, 2026. Here is the closing snapshot you need to know. The Nikkei 225 aggressively reclaimed that crucial 66,000 threshold today, advancing 384 points to close up 0.58% at 66,241.13. What we saw was intraday dip buying stepping in to perfectly offset some early weakness in the semiconductor bellwethers. The TOPIX, it just pushed its winning streak to a fifth straight session, climbing 0.5% to 4,114.23. But here's the critical takeaway. That NT ratio is structurally expanding to 16.10. This moderate steepening is a textbook reflection of balanced institutional capital allocation, with flows moving strategically into both cyclical value sectors and large-cap industrial exporters. On the rates side, the 10-year Japanese government bond yield eased just a single basis point to 2.80%, while the USD JPY cross rate stayed locked in a super tight corridor, finishing up just 5 sen at 159.25. Okay, let's dive into this, because grasping the core macro transmission mechanics at play here is absolutely essential. The Japanese capital market essentially functions as an open transmission nexus, and the baseline for literally all of it is the relative monetary policy path between the US Federal Reserve and the Bank of Japan. Whenever we see shifts in the Fed funds rate, it directly alters that US-Japan 10-year sovereign bond yield differential. And it's that specific spread that dictates the exact pricing for the USD/JPY exchange rate. When the spread is wide, the yen carry trade absolutely flourishes, borrowing that low-cost yen to deploy into higher-yielding global assets. But as global rate expectations shift and the BOJ moves toward normalization, that yield differential is what's going to dictate the velocity of global liquidity flows and cross-border algorithmic hedging. So, to really understand how that macro FX rate trickles down into domestic microeconomics, we need to talk about the 145 to 150 JPY range. This is the Solte Kawase Reto, basically the baseline corporate budget FX assumption that major Japanese manufacturers bake into their earnings guidance. With today's spot rate holding strong around 159.25, the Japanese export sector, think major auto OEMs like Toyota, are operating with massively protected forward operating margins right now. To put that into perspective, just a one-year depreciation against the dollar can bump aggregate operating margins across automotive and tech hardware by roughly 0.4% to 0.9% annualized. Today's stable rate is giving these companies tremendous operational cash flow visibility, completely avoiding that painful imported margin compression that domestic utility sectors always have to worry about. And that massive corporate cash flow visibility? That is the exact fuel driving domestic wage growth, which brings us to the SUMCO. The Spring Wage Offensive is the annual wage negotiation between enterprise labor unions and corporate management. For global allocators, you really can't just dismiss this as local labor news. It's actually the definitive macroeconomic leading indicator for the Bank of Japan. The BOJ meticulously monitors the SUMCO to confirm a sustainable wage price virtuous cycle. It is precisely this confirmation that has allowed uncollateralized overnight call rates to hold incredibly steady near 1.0% today, giving policymakers the stable bedrock they need as they prep for their autumn assessments. Make no mistake about the gravity of this transition. The structural departure from multi-decade unconventional monetary accommodation, specifically tearing down the negative interest rate policy and yield curve control, this is a fundamental regime shift for domestic asset pricing. We are no longer talking about transient market noise or temporary FX blips here. The BOJ's progressive normalization is establishing a genuinely market-determined sovereign yield curve, and that completely rewrites the cost of capital across the entire Japanese economy. It's restoring secondary market price discovery and introducing real balance sheet friction for highly leveraged, capital-intensive domestic industries. Now, what's really interesting about this is how this fundamental regime shift cascades so unevenly across different sectors. Take a look at the megabanks. Players like Mitsubishi UFJ and Mizuho traded very constructively today. Why? Because they have an asymmetric positive correlation to rising rates. As the sovereign curve steepens, especially out there on the 20 and 30-year tenors, it uniquely expands the net interest margin across their massive corporate loan portfolios. Their asset yields are expanding way faster than any translation friction. On the flip side, domestic utilities actually benefit when the yen is strong, thanks to lower imported input costs for things like LNG and coal, while large-cap exporters absolutely thrive under yen weakness. But here's the thing, macroeconomic transitions are only half of the Japanese re-rating phases. The other half is the dramatic corporate governance paradigm shift being driven by the Tokyo Stock Exchange. The TSE and the Financial Services Agency are aggressively forcing balance sheet rationalization across the prime market. Ever since their mandate in March 2023 targeting companies persistently trading below a price-to-book ratio of 1.0x, we've seen 3 specific, powerful mechanisms kick into gear. Number 1, the dismantling of cross-shareholdings. Number 2, record-level open market share buybacks explicitly designed to push return on equity closer to US and European benchmarks. And number 3, the rationalization of Oyako Jojo, or parent-child dual listings, which have historically been a nightmare for governance conflicts of interest. Let's actually drill down into that first mechanism, because it's arguably the most impactful of the bunch. Mochi-ai. These are strategic cross-shareholdings, reciprocal equity stakes historically held just to cement commercial relationships and insulate management from hostile takeovers. In the context of modern governance analysis, they are a massive misallocation of capital that absolutely crushes ROE. But now, under intense regulatory pressure and the threat of proxy advisor voting sanctions, these historic holdings are being aggressively unwound. The result? The divestment of Mochi-ai is generating staggering cash windfalls. And rather than just hoarding this cash like they did in past decades, Japanese corporations are strategically deploying it right back into R&D, core capital expenditures, and funding those exact shareholder buybacks we were just talking about. And this brilliantly illustrates exactly where a huge chunk of that freed up capital is going. It's fortifying Japan's impenetrable structural moats. Japan holds an absolute oligopoly in semiconductor upstream materials. Shin-Etsu Chemical and SUMCO command an astounding 90% of the global supply for high-purity monocrystalline semiconductor wafers. On top of that, Japanese chemical enterprises hold a 70 to 90% market share in advanced photoresists. So, while we saw some selective profit-taking today with companies like Tokyo Electron ahead of US earnings, this domestic ecosystem forms the absolutely critical, irreplaceable upstream nodes of the entire global AI and semiconductor supply chain. Beyond tech hardware, we've got to acknowledge the persistent underlying strength of the Sogo Shosha, the general trading companies. Today, trading conglomerates like Mitsubishi Corporation and Mitsui & Co. maintained incredibly firm price action. And that makes total sense, because these entities have evolved far beyond being just simple transactional middlemen. They are now operating as highly sophisticated, diversified asset managers and private equity operators. Their competitive moats are locked in by directly owned, vertically integrated midstream energy supply chains and massive merchant cash generation. When you combine that with deeply disciplined capital allocation policies, it's pretty obvious why they attracted that multi-year validation from global institutional titans like Berkshire Hathaway. So filtering out all the noise, here is your strictly data-driven forward watch list as we head into the next global trading session. First, monitor the global tech earnings spillover. Tonight's high-beta US semiconductor earnings and data center revenue guidance are going to absolutely dictate tomorrow morning's opening momentum for Japanese capital equipment and advanced materials suppliers like Advantest and Tokyo Electron. Second, all eyes remain on the Jackson Hole Economic Policy Symposium. Market surveillance needs to stay laser-focused on forward sovereign yield differential signals and any potential FX cross-volatility, because central bank policy divergence is going to continue dictating cross-border liquidity flows. The Japanese capital market represents one of the most substantial structural re-rating opportunities in modern history, sitting right at the exact intersection of a massive macroeconomic regime change and historic corporate governance reform. The data is totally clear, the mandates are locked in place, and the capital is moving. So the ultimate question for institutional allocators is this: with the Bank of Japan normalizing rates and the Tokyo Stock Exchange aggressively accelerating corporate governance, is your portfolio genuinely positioned for Japan's structural re-rating, or are you just temporarily trading the yen beta? Thank you for joining this explainer. Make sure your models are updated for the Tokyo Open.